I'm going all in on big tech. Wow, Joseph Carlson with a very interesting video, and some would view it as a controversial video he released yesterday. And I want to go ahead and react to the first half of this video. I think he brings up some great points in this one. I have a few points. I might have a little bit of a different opinion that I want to kind of share with you guys here today, but I thought, man, this is an interesting video. Let me know in the comment section if you have already seen this video or not. I'd love to hear from you guys as always. But other than that, I just want to get straight into this. Like I said, we'll watch the first half. If you want to watch the whole video, you can check out obviously his channel. And yeah, appreciate everybody subscribe to the channel. New all-time high subscribers in the history of the channel. I appreciate y'all being here as always. And let's jump straight into this.
Big tech companies are going to outperform the market. That is the case that I'm going to make in this video. Now, I've done videos on big tech many times in the past, and I've made some of my biggest investments, my biggest gains, and my biggest videos on big tech itself. So this is nothing new. I've been doing the same thing that I've always been doing, but I'm doing it more aggressively in the story fund. I'm basically at this point all-inning big tech. I have Amazon as by far my largest holding. This is a big tech company at a 35% weighting. Then we have Google, we have Microsoft, and we have Apple. And in my other portfolio, I even have more Apple and more Microsoft. So I am...
Okay, so first off, do I think, and for full disclosure as far as like my own positioning in regards to big tech. So in the public count, I have my Meta shares, obviously the biggest position in there. Certainly put Meta into big tech, right? It's a position that's doing us very well. I think it'll be doing us much better in the future. Do I think Meta will outperform the market over the next 5 years? Probably. I would definitely put the odds on Meta over the market in general, over the S&P 500. Tesla. Tesla obviously has been a tremendous stock for me over time. With that being said, the last probably year and a half to 2 years has been a struggle with Tesla, right? A lot of ups, a lot of downs, but a lot more downs than ups over the last year and a half to 2 years. And so in regards to Tesla, do I think it will outperform the market over the next 5 years? I would say probably, actually. Over the next 12 months? I don't know. Over the next 5 years? Probably. Amazon. Do I believe Amazon will outperform the S&P 500 over the next 5 years? Absolutely. There's another pretty good sized position for me, $142,000 in the public account. Doing well for us so far, but a long way to go. And then I even own a stock like Skyworks Solutions, which you wouldn't call it a big tech stock, but they're very close relation to a big tech stock because they get significant amounts of their revenues from Apple, the biggest of the big tech stocks, right? Usually 40%, if not well over 40% of the revenues come from Apple. So do I think Joseph Carlson is correct in that big tech stocks will outperform the S&P 500 over, let's just call it the next 5 years? In my opinion, he's correct. I believe big tech stocks overall will outperform the S&P 500 in total over the next 5 years, which isn't a crazy assumption to make. I mean, look at the Qs versus S&P 500 over time. Like, generally these companies are the best of the best.
On big tech. And I think that this is an area where investors get this wrong. They get it frequently wrong. They believe that the best days for big tech is largely over. They believe the companies are too mature to continue outperformance. And they continually believe that the companies are at too high of a valuation. These are all concerns that other investors have, and I want to address them in this video. So we're going to be going over why I think today big tech will continue its outperformance. Now, in order to make my case for the continued outperformance of big tech, I want to address what I call the concerns. And I'll list off concern number one as it being too obvious. A lot of people say, Joseph, it is simply too obvious of an investment. Everyone knows about big tech. They know about Apple. They know about Microsoft. You think that you are able to know something different? And if everyone knows about it, then it's obviously priced to perfection. It's priced with all the information that's all relevant, that's available. So big tech is already priced appropriately to its future growth. That is a claim or concern number one. And this one has been proven inaccurate time and time again.
Yeah, real quick here, okay? Nothing's ever priced accurately in the stock market. Like most of the time, stocks are either priced overvalued or undervalued. Very rarely are they priced appropriately. And some time periods, stocks are massively overvalued. In some time periods, stocks are massively undervalued. And one of the best metrics you can look at for this is you can look at trailing 12-month PE and you look at forward PE. And you could look at those over the past 20, 30 years. You can look at those in the same similar interest rate environments and then be able to judge, okay, am I getting the stock undervalued, overvalued based upon growth rates, based upon historical standards, and based upon where the market's trading at that given moment?
I want to go ahead and just take a look at some of these companies here. I'm aware that everyone knows about Amazon, everyone knows about Google and Microsoft and Apple. These companies are covered by legions of analysts. Wall Street, they have buy-side analysts, sell-side analysts. They have price targets on it. So many people doing research on these companies. But what we find is that doesn't really matter. What I want to show you is a write-up, and this is from MBI Deep Dives, which is mostly borrowed ideas. It's a great Substack. You can find him on Twitter as well. But I want to share a couple different data points he brings up here about a recent write-up on big tech. Here's the data that he highlights over the past decade. If we go back to 2013, big tech, being defined as Apple, Microsoft, Alphabet, Amazon, and Meta, had market caps of Apple being 500 billion.
It's insane because as of today, Apple's market cap is, the stock's down a bit, so it's still probably close to a $3 trillion market cap, maybe 2.7, 2.8, something like that. Microsoft's probably a $2.7 billion market cap probably right now, somewhere around there. Google McDougal's probably around $1 trillion. Amazon's likely a little over $1 trillion, and Meta's right around $1 trillion as well. Okay, so that just gives you some reference of, people thought many of these companies' best days were already behind them at that point in time, and obviously it was just very early innings still.
Soft, 225 billion. Alphabet, 232 billion. Amazon, 114 billion, and Meta, 58 billion. In aggregate, big tech was worth $1.1 trillion at the end of 2012. Over the last 10 years, from 2013 to 2022, big tech collectively generated $2.3 trillion in operating cash flow, slightly more than double their aggregate market cap 10 years ago. So the price that you could have bought all of these companies back in 2012 or the end of 2012, they've since generated over double in operating cash flow than the entire market cap combined. To say it differently, big tech was a form of deep value investing that was deeply underappreciated, even though they are widely followed companies at the time. So the point that he's making here is a point I fully agree with. These companies back in 2012 were also the most covered companies, the most analysts looking at them. They were the biggest companies in the world at the time. A lot of investors had the same assumptions back then that they do now. Well, you can't just buy Apple. That's too obvious. Everyone knows about Apple. Every analyst is covering Apple. Apple's not going to outperform because everything's baked into the price. But the reality is much different. What we see is that even though these companies were the most followed, most looked at, most analyzed companies on planet Earth, they still were deep value. They still were dramatically underappreciated by the market. And not just one of them, all of them. All 5 of them were dramatically underappreciated. And that's another point that he makes here. It wasn't just survivorship bias of 1 or 2 of the companies. It was literally all of them. What is perhaps even more strange is that this underappreciation was not quite specific to 1 or 2 companies, but the entire group. No company was, however, underestimated as much as Meta Platforms, formerly known as Facebook, generating $271 billion in operating cash flow, and it was 470% of their entire market cap in 2012. So Facebook was deeply, deeply undervalued back in 2012. So we go back to this.
Back in 2012, a lot of the talk around Meta at that time, and I know this is so silly to think now, but these are the 2 main negative things that were brought up consistently in regards to Meta back then, right? 1, this is probably just the next MySpace, and everybody's going to go to the next thing, and you're probably going to become irrelevant. Obviously, we know that wasn't true, okay? And the second thing is even more laughable than that, much more laughable. How are they going to make money? That was the subject in 2012 around Meta back then. I remember it was all about, how are they going to make money? I don't get it. All these people use it. It's free. How are they going to make money? Now we understand ads, and a million other ways they can make money. But that was the talk. That was the debate, right? And obviously, neither of those came true or even close to true.
Joseph, how do you know anything extra about big tech? It's already widely covered by analysts. Well, it was widely covered by analysts 10 years ago. Apple is the biggest company in the world 10 years ago. In fact, all of these companies were some of the biggest in the world 10 years ago, and they were dramatically, deeply undervalued. In retrospect, these were some of the most deeply undervalued and underappreciated companies in the market. And this sounds very counterintuitive. As big tech grows and there's more analysts covering them and there's more excitement and people looking at these companies, not only do they not get more efficiently priced, but they become less efficiently priced. That sounds crazy, I know, but that's the case. Let's go ahead and take a look at some examples here. I'll try to convince you of this. We have here Dataroma, which has the super investor list. And these are investors that control over $100 million in assets under management. Many of them are notable investors with long histories of outperformance. But then you also have a lot of investors that are doing mediocre. Frankly, I would say around 80% of this list generate no alpha. 80% of these super investors do not beat the market. There's only a handful, maybe 10 to 20% that actually have consistent outperformance. But one of the things I noticed when looking over this list of 78 super investors is, let's just go ahead and take a look at something here. Let's type in Apple. This shows us all the super investors that are in Apple. Now again, there's 78 super investors, and we have one super investor that has a lot of Apple, Warren Buffett. So one super investor has half his portfolio in big tech, and he owns a couple other big tech companies as small holdings. But Buffett has 51% of his equity portfolio, the public one, in Apple. So Buffett's not afraid of concentrating big time into big tech. But Buffett is different than 80% of these super investors. Buffett creates alpha. Buffett is a good investor. He really does better than the market consistently. And it's
so I'm probably one of the biggest Warren Buffett fans in the world, right? And super thankful for obviously everything he taught me over time in watching his videos and hearing his perspectives, especially in my first few years of investing. But I got to push back against Buffett. Buffett has made this a very large position over the last 5 years. But if I think about his biggest positions the last 10 years, what if I told you his biggest positions over the last 10 years have not only underperformed big tech and the Qs massively, but have significantly underperformed the S&P 500. Let me show you the past 10 years. And obviously Buffett, he always wants to be judged on 10-year, time frames, right? 1 year, 2 year, 3 years, no one wants to be judged on that. It's really about 10 years. So if you know anything about Buffett, you know his biggest positions over the last 10 years, okay? His biggest positions are companies like American Express, are companies like Bank of America, Coca-Cola, Chevron, okay? Those are his biggest positions. Now, over the past 5 years, obviously he's added Apple as one of his biggest positions. But if you're thinking over the next 10 years, is Apple going to outperform the S&P 500 or the Qs? Don't be convinced of that, okay? Look at this. Chevron in the last 10 years is up 34%. That's versus 164% gain for the S&P 500 and 380% gain for the Qs. Now, Buffett's a legend, so a lot of people don't even really want to question him. He's like the Bill Belichick of investing, right? Coca-Cola, the last 10 years is up 51%. That's versus 164% for the S&P 500. That's versus 380% for the Qs. Bank of America, 95% gain in his best stock of his big, most important investments is American Express at a 190% gain over the last 10 years. That's versus 164% for the S&P 500, and that's versus 380% for the Qs. So, Buffett is my man, legend, around Mount Rushmore. But the fact is, Buffett's biggest investments have not been doing well. They've been underperforming and not generating alpha for the last 10 plus years, okay? This is just something to take into account that matters, because if you're banking that, Warren Buffett's such a big investor in Apple, this means it's going to outperform the market. It's not the way it works, okay? That's not the way it works. There's a potential that it could. But if it's anything like all his other biggest investments over the last 10 years, then it actually won't, okay? So that's something I got to push back on there.
Well, that one of the investors that consistently beats the market has half his portfolio in big tech. On this list, we only have 13 super investors that own any Apple at all. Again, out of 78, only 13 own Apple at all. And then out of this 13, half of them have less than 2%. In fact, over half of them. In fact, only 5 of them have above 3% Apple. So 5 out of 78 super investors own any Apple. And Apple, of course, has been a huge outperformer over the past 5 years. So I asked the question, why do these investors not hold a lot of Apple? In fact, when we look at other big tech companies, we can look at Microsoft. We can see how many own this one. It's more, but it's still not weighted up to the index. Right here is where the index weights Microsoft. We have about 14, 13 super investors in it. And then every other one out of the 70 have underweighted Microsoft. And you can do the same thing for Google and GOOGL. When you combine those and add them together, only around half of the investors even own Google at all out of these super investors, and the majority of them do not have Google overweighted. Some of them do. There's, again, around 10 to 20 of them that do, but there's around 50 of them that don't. So the majority of super investors still don't invest in Google as well. Now, my big question was why? Why do most investors, aside from a few like Warren Buffett that owns a ton of Apple, but most super investors have very little, if any, exposure to big tech? What would be their possible reasoning for doing this? When I do analysis, big tech is oftentimes the best companies in the market at very reasonable prices. So wouldn't super investors be clamoring to own these companies? Why are they so underweight big tech? Well, the answer dawned on me. It's simple. It's basic incentive. These companies are too obvious. Consider this for a minute. I get criticized as a content creator, as an investor, for doing the obvious thing, investing in big tech and buying up the biggest, most profitable companies at reasonable valuations. But I'm not managing other people's money. Imagine if you were paying me to manage your money, and then all I did with it was I bought Amazon, Google, S&P Global, Microsoft, Apple, and Netflix. And I sat it there for year after year after year. Would you really feel like you're getting your money's worth? Now consider the fact that these super investors are running big funds where they get money based on assets under management. They charge 2 and 20, 2% of the assets under management per year and 20% of the gains. So they're charging hefty fees for their services of picking out stocks. And why would all these investors give them assets to management if they did the obvious thing? If they invested in the best companies at the most reasonable valuation? Well, if they did that, they couldn't justify their expensive fees. This is basic incentive. These super investors are incentivized to make it look like they're doing something special and different and unique. They're not incentivized to do the obvious thing, even when the obvious thing is the better thing to do. So it comes down to basic incentive. I believe a lot of the reason that these investors are not investing in Google or buying up Meta like crazy or owning tons of shares of Amazon is they couldn't justify their fees. If they just stick all of their money in big tech, yes, they'd likely outperform, but the investors giving them all of this capital would realize...
So Joseph has a good point here, but also I think there's another point, another side of the story that needs to be talked about that's very important, okay? Is remember, these are hedge funds, right? Many of them, it can be other funds as well. Many of them don't want to be overexposed to one stock, right? 51% of your portfolio or 25% or things like that. So most of the time, they're going to try to keep any position they have under 10%. Some of them, they have to, like they're forced to. It's either, it could be something in regards to the fund itself where we can't have any position over 10%. And so that's one thing. Warren Buffett can do it, that's fine, but these other folks many times just aren't literally allowed to do it, so they have to keep it under 10%. That doesn't mean they're not the most invested in stocks. They are the most invested in stocks, right? It's just they're not to the 20%, 30%. Also, that's seen as risky. Let's just call it what it is. If, let's say, recently I actually was reading that some folks pretty high up at YouTube, some senior folks at YouTube, are worried about shorts, taking away time from longer form content on YouTube, right? And YouTube's actually being disrupted by Instagram, through Instagram, obviously their content reels, and being disrupted by TikTok, right? And that's causing a lot of people to watch very short form content, have lower attention spans, and kind of create this bad dynamic, certainly for longer form content, which is the stuff more that obviously is beneficial to Netflix, YouTube, platforms like that, right? So if that's going on, that's something that's seen as risky. Well, if you've got half your portfolio in Google stock, gosh, you're feeling a little like, oh boy, what if something happens with YouTube here? What if this is actually disrupted in a major way and either the business isn't as profitable or just not nearly as relevant, right? You guys look at it from like a Google search side, and I just want to stick to Google for a moment, right? Of Google search, like, gosh, if that's ever disrupted, oh boy, what does that mean for a company like Google over time when most of their business is in Google search and obviously YouTube? So these are just things to, at the end of the day, especially if you run a hedge fund, you have to kind of de-risk a bit. Remember, who's investing with a lot of these funds in ETFs? Okay, is it the average Joe with $2,000? No, these are high net worth individuals. So they're not as worried about the upside. That's why even they keep their money even with guys that are underperforming, which 80% of the fund managers or whatever underperform the market. Because a lot of times people say, I already got a big net worth. I'm already worth millions, tens of millions, hundreds of millions, billions. I just don't want to go down a lot. Well, if you got 40% of your portfolio, 50% of your portfolio in one stock, oh, guess what? You're going to go down a lot. You will, okay? It's just a question of when does it happen. The best stocks in the world go down big. And if you got 50% of your portfolio in that one stock and now's the time it's going to drop 50%, oh boy, I can tell you your clients are not going to be happy with you when their net worth is half. So that is another thing to kind of take into account there that I think there's always, two parts of the story, right?
They don't need to be paying them to do that. In fact, one of the only investors on this entire list of super investors that does not have this perverse incentive of trying to look special and unique and like they're finding these very exciting, unique investments is Warren Buffett. Warren Buffett doesn't charge asset under management fees. There's no 2 and 20 for Warren Buffett. He doesn't charge you to put money into Berkshire Hathaway. He simply is running a business. So his decisions, Warren Buffett's decisions, are simply put, where am I going to get the best ROI? What are the best investments in the market with the lowest risk? And when all of those perverse incentives are removed and they're out of the picture.
I'm glad he said that, because at first when he said it's all about getting the best ROI, I'm like, no, it's not the way Buffett thinks. It's risk reward. Where am I going to get the most attractive risk reward profiles? What Buffett's really looking at.
Have no asset under management fees. You're not trying to look special and unique to justify your high fees. When that happens, what does it result in? He has 51% of his public equity portfolio in Apple. He seeks only a return on investment. That is his only incentive. The only thing Warren Buffett and Berkshire Hathaway wants to do is make money. So these companies being big and well known doesn't make them more efficiently priced. No, it makes them less efficiently priced. People are avoiding buying these companies. Lots of investors with lots of money, billions of dollars of invested capital, are avoiding buying these companies specifically because of adverse incentives. They cannot look special and unique if they buy big tech because they have to justify their management fees. Another investor that
one pushback I could have on Buffett here in regards to the Apple position specifically, he has so much of his portfolio. If he starts to dump Apple shares, I can tell you it's not going to be a good look, right? Because it's going to basically, people are going to say, oh, Buffett's starting to dump Apple. This means Apple's going down. This means, the Apple, basically the Buffett put on Apple stock is no longer there. Because right now, people look at Apple stock and they're like, Buffett holds a ton of the shares. He's not selling, so it just takes a huge, potential seller out of the market. And then Apple's always buying back stock, right? And so it's kind of seen as the Apple put and the Buffett put, and it puts like a floor under Apple stock, right? Well, if all of a sudden he starts dumping shares, that goes right out the window. All of a sudden people start questioning, wait, Buffett knows something? Is it overvalued? Is he going to continue to sell shares? And all of a sudden people aren't confident that Buffett holding his shares is going through. So he's almost kind of stuck with just holding Apple stock long term, because at the moment, if he sold a bunch of Apple shares, I'm telling you, it's going to be all over everywhere. Bloomberg top story, CNBC's top story, Yahoo Finance, everywhere. Buffett selling Apple stock. It would be everywhere. And honestly, he's kind of forced to not sell Apple stock right now. Otherwise, it's going to be the biggest news story in the investment community.
I could cite here as one that has a very perverse incentive when it comes down to it is Cathie Wood with ARK Innovation. She's supposed to invest in the most innovative companies in the world. Well, the most innovative companies in the world, objectively speaking, have been big tech. They're the ones coming out with new chips and new experiences, new devices, pushing things further and further. But instead, she's invested in Roku and DraftKings. When it comes down to it, Cathie Wood is charging 0.75 basis points for her fund. And if her fund mimicked the QQQ with an overweighting in big tech, well, why would you justify paying for her fees? She has incentive not to invest in big tech. So these companies are becoming less efficiently priced over.
Yeah, and another thing with Cathie, right? People like to play ARK specifically to try to get some sort of epic return, insane return, right? Well, maybe you can get that in some of the smaller stocks. Apple's not doubling next year. I hate to break the news to anybody. Apple stock's not doubling next year. But with Kathy and kind of her objective and what people look for Kathy for is they want ARK ETF to double next year. They want many of the stocks in her fund to double next year. And so that's where you start to look beneath the surface. Microsoft stock's not doubling next year. I hate to tell you, okay? So she's not even kind of looking at those sorts of companies. But I agree with Joseph in terms of many of the best workers in the world work for these big tech companies. They're the most talented. They have the most money to put into these massive projects that are very difficult to pull off. And so ultimately, many of these companies still are the best innovators out there in terms of the marketplace. So I do agree.
As they grow. Another thing we can look at is even the indexes. They actually go out of their way to curb their exposure to big tech because of concerns over concentration. The NASDAQ 100 plans special rebalance to curb dominance of the Magnificent Seven, which is big tech plus NVIDIA, a couple other companies. The NASDAQ 100 special rebalance will take place before the market open Monday, July 24th, to, quote, address overconcentration in the index by redistributing the weights. Now, there's no other reason why. They're not running valuations. They're not running discounted cash flows. They haven't come to the conclusion that big tech isn't deserving of it or their cash flows don't support the valuation and concentration. No, the NASDAQ decided to underweight these companies simply because they're too big. They just occupied too much space in the index. That was it. When you don't have these restraints or incentives.
And that is what it is, portfolio rebalancing. Now, two last things here, okay? Let's talk about some big tech stocks that, in my opinion, definitely have quite a bit of upside over the future years. Definitely, obviously, Meta, I believe in a great deal. Their valuation is so darn attractive, and they have so much growth runway ahead of themselves, right? Amazon, same exact situation there. Obviously not as attractive as of a valuation, but you get so many more growth levers long-term from Amazon than probably any potential company in the world. By the way, Amazon should buy out WBA. That would be a genius move, but that's a subject for another day. If I think about outside of that, certainly AMD, if they, actually come through with some, kind of epic gains in, no pun intended, in regards to what they're putting out there for AI products in 2024 and beyond, that's potential. NVIDIA certainly still has potential. Really depends on how big that market is, but based upon valuation and based upon growth rates, NVIDIA actually is a cheap stock right now, which is crazy to think, unless their business completely deteriorates in a massive, massive way. So that's, kind of what I think about Tesla. I think in the short term, rough road. I think long term, looking phenomenal in terms of the whole Tesla story. Now, in terms of Joseph Carlson and, him being almost all in big tech stocks, certainly that's his decision. I think there's a lot of obviously opportunities out there that don't always fit the criteria. My best stock the past 5 years is a cosmetics company, Elf Beauty, sitting at a 1,700% gain or something on that stock. It's my best stock. It's killed it. It's absolutely killed every other stock, including even Tesla Tesla, which is sitting at like a 900 or 1,000% gain or something like that, right? So there's a lot of gems you can find out there that aren't in big tech land. However, if you feel just more comfortable kind of being in big tech, then certainly you can be in just big tech, okay? I appreciate you guys joining me as always. Thanks so much for being here. Thank you for being subscribed. New all-time high subscribers in the history of the channel. Thank you for Joseph Carlson for putting out an interesting, potentially controversial video there. That was a fun one to react to. So much love and have a great day.